Hey everyone, welcome back. Ready for another deep dive. Today we're tackling backtesting and how things get really interesting and maybe tricky with machine learning in the mix.
Absolutely. It's powerful stuff, but there are definitely some potential pitfalls we want to help you avoid.
Right, like you're into data-driven approaches, which we love, but you also don't want to be misled by, results that look good but might not hold up in the real world.
Exactly. Got to make that research robust, especially these days when data mining can be, well, kind of dangerous.
Totally agree. So let's get into it. We're diving into a paper called A Backtesting Protocol in the Era of Machine Learning.
Oh yeah, good one.
It's got some serious names behind it, actually, like Nobel Laureate Harry Markowitz, published back in 2018, so might seem a while ago, but it gets at something that's only become more relevant.
Data mining thing, so alluring, but potentially a huge trap.
Right, and machine learning just amplifies that, doesn't it? So much power, but it's so easy to get lost in the data.
Totally agree. Think of this deep dive as like your cheat sheet to the paper's key insights. We'll cut through the jargon, highlight what matters most.
Love that. So anyone listening who's maybe intimidated by the paper itself.
And, good place to start is just realizing how much the research game has changed. Like, remember the Cray 2 supercomputer?
Oh yeah, vaguely. Like massive, right? Super expensive.
Cost a fortune. But your iPhone now can do trillions of operations per second. Way more than that Cray 2.
No way. It's insane how much computing power we have now.
And the amount of data. Forget about it. Makes data mining so easy, which, again, can be good or bad.
Definitely a double-edged sword.
Yeah.
So backtesting essentially is using historical data to see if an investment strategy would have worked, right?
Exactly. But with all this data, it's easier to find patterns that aren't really there.
Which is where things go wrong. The paper had this kind of funny example. A strategy they call S3U3.
Appeared super successful, like almost 6% alpha annually for 50 years.
Wow, okay, I'm intrigued, but also suspicious.
It was based on the letters in company ticker symbols.
Wait, seriously? So picking stocks based on if they start with ABC versus XYZ. That's wild.
Exactly. It shows how, even with things like cross-validation, which is supposed to help HLP avoid overfitting, we can still get fooled.
Especially with limited financial data, right? Like trying to find a needle in a small haystack.
Perfect analogy. And that leads us to the winner's curse idea.
Which is that the strategies we hear about, the ones that get published, often perform worse than their backtest suggested.
Exactly, selection bias at play. It's like that hot stock tip you get by the time everyone knows the opportunity's gone.
So how do we avoid being those people, chasing phantom profits?
That's where the paper's 7-point backtesting protocol comes in. Think of it as a checklist for more robust research.
I love a good checklist. What's the first category we got to pay attention to?
Research motivation, meaning before you even start, have a good reason why you're doing this research.
So not just, let's see what the machine learning spits out.
Nope. Have a solid economic rationale beforehand. Remember S3U3. If your idea's as flimsy as that, trouble.
Makes sense as you wouldn't build a house on sand. Got to have that foundation first.
Exactly. No inventing your story after you find some pattern. That's just fooling yourself.
So start with a good question, something rooted in how markets actually work, not just data quirks.
Right. Then we move on to the second category, multiple testing and statistical methods. This is where it gets tricky. Got to be careful about how we interpret statistical significance.
Okay, because if we run tons of variations of our model, we're more likely to find something that looks good just by chance, even if it's meaningless.
Exactly. Imagine 20 researchers in parallel universes, each testing a different strategy.
Okay, this is getting a little Matrix way, but I'm following.
Just by chance, one of them's likely to have amazing results, but it doesn't mean their strategy is actually good, right?
So how do we account for that parallel universe problem?
By being super careful with statistical significance. More tests, higher the bar needs to be. We're playing a numbers game.
More darts thrown at a dartboard, more likely to hit the bullseye, even if you're not skilled.
Perfect analogy. And it's not just the number of strategies, but also variable combinations we use. Lots of those. More risk of bogus results.
So good record keeping, essential. No sweeping those failed experiments under the rug.
Exactly. Transparency is key. Now, ready for the third category? It's all about the data itself.
Bring it on. Data is king, as they say.
Right. Sample choice and data. Be rigorous, transparent, bad data in, bad data out.
So what are the big no-nos? Like changing the time period you're looking at after you start.
Big one. No backfilling, no excluding periods that don't fit your narrative.
So temptation to cherry pick the data that supports your idea. Got to resist that. What about outliers?
Another tricky one. Tempting to just toss them out.
But it's data manipulation if we don't have a good reason to exclude them.
Exactly. Models should be able to explain valid data. What about Windsorization?
Yeah, that's like limiting the impact of extreme values, right?
Exactly. Perfectly fine to use, but decide on that beforehand, not after you've seen how it affects your results.
So like if we're measuring average height and there's one giant, we decide beforehand to cap everyone at, say, 7 feet for a fairer average.
Great analogy. It's all about avoiding that temptation to massage the data to get the results we want. Transparency, predefined plan, essential.
Okay, so data integrity is paramount. What's next in this protocol journey?
Category 4, the one everyone loves to talk about, cross-validation.
The test of whether our model can actually generalize to the real world, right? Using data it hasn't seen before.
Yes, but there's a catch, especially in finance. Even out-of-sample testing might not be truly out-of-sample.
What do you mean? I thought that was the whole point, holding back some data.
The problem is we've lived through that whole period. Our knowledge of what happened influences our choices, even subconsciously.
So even if we hold back some data, our models are still shaped by what we know of that time.
Exactly, like trying to predict the end of a movie you've already seen. Authors suggest freshly uncovered data might be better, but
there's always going to be that element of our own experience shaping our choices.
Precisely. Makes you realize there's always some subjectivity, even when we're trying to be objective.
That is humbling. And then there's the danger of iterated out-of-sample testing, right? Which leads to more overfitting. Iterated out-of-sample testing. What is that exactly?
It's when you keep tweaking your model after seeing its out-of-sample performance. Tempting to improve the fit, but
it's like using the answer key to cheat on a test. You'll get a better score, but it doesn't reflect your real knowledge.
Exactly. So set clear rules up front. Decide on your testing method before you do it, and stick to the plan.
Got it. Discipline and predefined rules. No cheating allowed.
Precisely. One more thing before we move on, something often overlooked, especially in academia, but crucial in the real world.
Okay, lay it on me. What's this overlooked element?
Trading costs and fees. Easy to get excited about a strategy with great back-tested returns, but
those can vanish once you factor in what it actually costs to execute those trades.
Exactly. Got to include those realistic costs in both in-sample and the out-of-sample analysis.
So, gotta be realistic. No assuming we can magically trade at the exact prices in our backtest.
Right. Speaking of reality, let's move on to the fifth category, model dynamics. This is where we acknowledge that markets aren't static.
Oh yeah, good point. A model that worked great in the past might totally flop in the future.
For sure. Markets evolve constantly, influenced by so many things. Regulations change, technology advances, investor behavior shifts.
Like trying to navigate a maze that's constantly rearranging itself.
Perfect analogy. And then there's the Heisenberg uncertainty principle, which actually applies here.
Wait, isn't that a physics thing about measuring particles?
Yep. But the idea is just like observing a particle can change it, our very act of studying and exploiting market inefficiencies can change them too.
So the more we try to exploit an edge, the more likely it is to disappear. Kind of like when you shine a light on a cockroach, it runs away.
Exactly. It's what the authors call overcrowding. As more investors pile into a strategy, it can become less effective.
Wow, that's mind-blowing.
Yeah.
So we're not just passive observers of the market, we're active participants, and our actions can actually change the game.
Exactly. Highlights the importance of being aware of those feedback loops. Gotta be humble about our predictive powers.
Right. Always learning, always adapting. Can't get complacent.
Absolutely. So on to the sixth category. Ready for it. This one's all about model complexity.
Hit me with it. Especially in the age of machine learning, it's tempting to make things super complex, right?
Right. We have all this data, all this computing power. Feels like more is always better, but the authors warn against the curse of dimensionality.
Ooh, that sounds scary. What is the curse of dimensionality exactly?
Basically, the more variables you add to your model, the more data you need to support it. And we know financial data is limited.
So more variables doesn't necessarily mean a better model. Could even make things worse.
Exactly. Increases the risk of overfitting. That's why they advocate for simplicity and regularization.
Okay, simplicity, I can get behind that. What's regularization, though?
Think of it as a way to prevent your model from getting too creative with the data. It imposes constraints on the complexity.
So finding that sweet spot between fitting the data well and keeping the model simple enough to generalize to new data.
Precisely. Another point they make is about interpretable machine learning. We shouldn't treat our models as black boxes.
Right, no blindly trusting the algorithm. Got to understand how it's making decisions, if those make sense economically.
Exactly. Ties back to that solid economic foundation we talked about. It's not just about finding patterns, but understanding why they exist, if they'll persist.
So not just data crunching, but real understanding. Got it. What's the final category in this backtesting protocol adventure?
This one's a bit different. It's about research culture itself.
Oh, interesting. So not just about individual researchers being rigorous, but the whole environment they work in.
Exactly. Think about the incentives. Are researchers rewarded for truly robust strategies or just for backtests that look good?
Right. If the incentives are messed up, that encourages bad research practice.
Exactly. So, gotta create a culture that rewards the right things. Rigor, transparency, willingness to admit failures.
Which can be tough, especially in finance, where there's so much pressure to outperform.
Very true. But a healthy research environment means setting realistic expectations, knowing that most experiments won't lead to a super profitable strategy.
So embrace those failures, learn from them, keep iterating, and I guess reward that process, not just the wins.
Exactly. And be extra careful with delegated research. Juniors might be tempted to cherry-pick results to please their bosses.
Right, got to create that culture of intellectual honesty, everyone committed to finding the truth, not just a pretty backtest.
Absolutely. The goal is an investment process that actually delivers in live trading, not just on paper.
Makes sense. So this 7-point protocol is like a roadmap for that, right? Minimizing self-deception, building a process that's grounded in sound economics and rigorous testing.
Exactly. It's a call for humility, a reminder that even with machine learning, good research principles are still key.
Don't get lost in the data, stick to the fundamentals, be skeptical, and keep learning. Sounds like a plan. Wow, that was a lot to unpack. 7 categories, each one with so much to consider. Backtesting is definitely not as simple as I thought.
Nope, not at all. It's easy to get lost in the weeds, you know? Focusing on the technical stuff, but missing the big picture.
Right.
What it all means for you as an investor.
Right, like how do we actually use this protocol? What are the key takeaways we should be focusing on?
Well, the big takeaway is that we're in this new world of quantitative research, especially with machine learning. So much power,
But also potential for disaster if we're not careful.
Exactly. Data mining, overfitting, those are serious risks. That's where the protocol comes in.
It's like a guidebook for navigating this new landscape, making sure our research is actually, good research.
Exactly. Doesn't mean abandoning machine learning or anything, but using it responsibly with a healthy dose of skepticism.
So like a checklist to evaluate our own research and the research we see from others, right?
Exactly. Does it follow the protocol? Solid economic foundation, aware of overfitting. If the answer to any of those is no.
Red flag.
Yeah.
Don't get fooled by fancy backtests or models that seem too good to be true.
Right. Remember that S3U3 strategy? Impressive results, but built on nonsense.
Yeah, that one's a good reminder that even sophisticated looking stuff can be totally meaningless.
So look for substance over style. Research that's clear about its methods, grounded in economics, and honest about its limitations.
So it's not just about the result, it's about the process.
Exactly. The good process is what leads to good decisions in the long run.
And all this ties back to the winner's curse, right? The research that gets published is often the one with the most eye-catching results,
Which might just be a fluke. The winners of the data mining contest, but not necessarily the strategies that will actually work going forward.
So got to be critical consumers of research, right?
Yeah.
Don't just take backtests at face value, dig deeper.
Exactly. Understand the methods, the data, the assumptions. And if something seems too complicated, too reliant on weird data points,
Be suspicious. It's like
Yeah.
the simpler and clearer the explanation, the more likely it is to be true, in my experience.
often, yeah. We want strategies that are both statistically significant and economically meaningful and robust to real-world stuff.
Right, like trading costs, which we talked about. Got to be realistic, not living in a theoretical bubble.
Exactly. So the backtesting protocol is like our tool for doing all that, right? Asking the tough questions, challenging our assumptions, staying grounded in reality.
It's about being honest with ourselves, acknowledging the limitations of what we know, the uncertainty that's always there in markets.
Well said. I know this can all feel overwhelming. There's so much to think about.
My head is spinning a bit, to be
Yeah.
honest.
That's totally understandable. But you don't have to master it all overnight. Start with those core principles. Get comfortable with them.
Like that clear research motivation, accounting for multiple testing, being super rigorous with our data, all that good stuff.
Exactly. The more you practice it, the more intuitive it becomes. Like anything, it takes time.
And the less likely we are to fool ourselves, which is, I'm realizing, a big part of this battle, right?
Absolutely. The paper says it well. In a world of more and more data, more complexity, the principles of good research are even more important.
Don't drown in the data. Stick to those fundamentals. Stay skeptical. Solid advice for life in general, I think.
Definitely. And remember, even with the best process, no guarantees in investing.
Oh, for sure. That's part of the fun, right?
Yeah.
But we can definitely improve our odds.
And invest with more confidence, more peace of mind, knowing our decisions are based on something solid.
I like that. Investing with confidence and peace of mind. That's a great goal to have. But this paper, it wasn't just about backtesting, right? It felt bigger than that.
Yeah, you're picking up on something important. While the focus is on investing, these lessons apply to A&Y research.
Oh, interesting. So it's not just for finance people.
Nope. Marketing, science, anywhere you're using data to make decisions. Those principles of sound research, they're universal.
It's about being a critical thinker, demanding evidence, holding ourselves and the others accountable for the quality of the work.
Exactly. And that leads to our final provocative thought for this part of the deep dive.
Okay. I'm listening. Hit me with it.
The paper argues that research culture plays a huge role. It's not just about individual researchers being good, it's the environment they're in.
Right. Like, are they rewarded for the right things? For finding truly robust strategies? Or just for producing results that look good on paper?
Exactly. If the incentives are messed up, it can create a whole culture of bad research. And that's a problem, not just in finance, but anywhere.
That's a scary thought. So, gotta be aware of those incentives. Make sure they're aligned with good practices.
It starts with recognizing the problem, then consciously creating a culture that rewards transparency, rigor, all that good stuff.
Easier said than done, I imagine. But it's on all of us, right? Researchers, investors, everyone who uses research.
Exactly. You, as consumers of research, you have power. Demand better standards, ask tough questions, support those who are doing it right.
That's a great point. We all have a role to play in making research better, more trustworthy.
By raising our collective standards, we can create a research environment that's more likely to produce meaningful results.
That's a goal worth striving for. Now, I'm ready for the final part of our deep dive. Let's wrap this up. It's interesting, right? We think about progress as new tech, more data, faster computers. But sometimes progress means taking a step back.
Yeah, reevaluating how we do things, how we think.
Exactly. And this paper from 2018, it's like they saw the machine learning wave coming and the potential problems before it was a big thing.
Absolutely. They were ahead of the curve. A call for sanity in a world that loves complexity, loves those black box solutions.
But the paper's saying, hey, those fundamentals of good research, clear thinking, logic, honesty, Those never go out of style.
And it's
A plea for a more thoughtful approach. Less about the flash, more about substance.
exactly transparency over obfuscation, long-term success, not just chasing quick wins.
Building a research culture that's resistant to, like, the siren song of data mining and overfitting. Those tempting but dangerous paths.
Right, recognizing that the pursuit of alpha, that outperformance everyone wants, it can lead us astray if we're not careful.
So not abandoning the pursuit, but doing it responsibly, sustainably.
Exactly. And that's where the backtesting protocol comes in, making sure that pursuit is grounded, rigorous.
A roadmap for this complex world of quant finance, reminding us that we're all prone to bias, to seeing patterns that aren't real, overfitting to the past.
We've got to be vigilant, skeptical, always questioning our own assumptions.
Right. It's like a constant battle against our own brains, wanting to find those easy answers, but often the easy answer is the wrong answer.
Exactly. The paper is a call to action to raise standards across the whole investment industry.
Investors first, building trust, making sure the pursuit of alpha is actually aligned with, like, good investing principles.
Well said. And zooming out even further, it's not just finance, it's any field where data drives decisions.
Be critical thinkers, demand transparency, hold each other accountable for the quality of the research.
Because ultimately, it's about the truth, right? The quest for knowledge, and that requires humility, curiosity, and yeah, a lot of hard work.
Couldn't have said it better myself. So to wrap up our deep dive, what's one final thought for our listeners as they continue their own investment journey?
Be wary of data hacking, that temptation to just keep searching for patterns until you find something that looks good, even if there's no real logic behind it.
Right, forcing the data to tell the story we want instead of listening to what it's actually saying.
Exactly. That's a recipe for bad decisions. Look for simplicity, clarity, economic logic.
The best strategies are often the ones that make sense, that are based on timeless principles, not just some fleeting quirk in the data.
Well said. And on that note, we'll wrap up this deep dive. Hope it's been insightful and helps you navigate the investment world with more confidence.
More confidence and more peace of mind, knowing your decisions are well informed. And hey, if you ever find yourself drowning in data, come back to this protocol.
It's your guide, your compass for doing better research, making smarter decisions.
Thanks for joining us, everyone. Until next time.
Welcome back to the deep dive. Today, we're searching for that holy grail of investing, right? Trying to build a stock portfolio that doesn't just like sit there, but actually, grows, but also doesn't give us all heart attacks every time the market takes a dip. And, well, we found some really fascinating research that might just hold the key.
The thrill is in the chase.
Exactly. So buckle up because we're diving headfirst into the world of hierarchical momentum. And to help us navigate these somewhat complex waters, I've got our expert right here with me.
Happy to be here. Always love geeking out about this stuff.
So this paper we're diving into, it starts off by pointing out something I think a lot of us have probably felt. You hear about these fancy Nobel Prize-winning portfolio strategies.
Right.
The Markowitz model. The problem is, well, they don't always work quite as well in the real world, do they?
Yeah, they're great ideas, in theory. But the market, it's evolved. It's like, imagine trying to use a map from the 1800s to navigate a modern city,
I like that analogy.
The amount of data we have about the stock market now is just, it's overwhelming for these older models.
It's like feeding them too much information and they just get indigestion, can't handle it.
Exactly. And then what happens is they might actually end up suggesting portfolios that are way too risky.
Yeah.
Concentrated in just a handful of assets.
Yeah, not exactly the recipe for, sound sleep at night.
Exactly. We need something a bit more robust, something that can handle the data deluge and still give us good directions.
Precisely. And that is where this idea of hierarchical momentum, or HM, this is where it comes in.
Right.
And it's really fascinating because it's like combining the best of, well, two different investing worlds' momentum, and then this idea of diversification.
It is. It's a really interesting approach.
So let's break that down a bit. For those of us who maybe skipped finance class, what exactly is momentum investing?
Well, the simplest way to think about it is, it's like that saying, ride the hot hand. It's based on the idea that stocks that have performed well recently, there's a good chance they'll continue to do so for at least a little while longer,
So kind of like sticking with the winner, or at least for a bit, hoping the streak continues?
Yeah, basically.
Yeah.
But of course, we don't want to put all our eggs in one basket, right?
Yeah.
We want to diversify, and that's where hierarchical clustering comes into play.
Okay, so now we're adding baskets to the mix. I'm intrigued, but I need a visual. What is hierarchical clustering?
Okay, so imagine you walk into, I don't know, a giant buffet, right? The stock market buffet, if you will.
I'm with you.
Now, instead of just randomly piling food on your plate, you decide to be strategic about it. So you group similar dishes together, maybe all the seafood in one spot, all the desserts in another, right? You're creating these categories. That's essentially what hierarchical clustering does, but with stocks. You're grouping them together based on how similar their price movements are. So you're creating baskets of stocks based on, their behavior, their personality in the market.
Okay, so finding stocks that, to move together up or down, sort of like dance partners on the market floor?
Exactly, that's a great way to put it.
So with hierarchical momentum, instead of just chasing after the single hottest stock out there, we're trying to pick winners from these different kind of categories. Is that what I'm hearing?
Exactly, you got it. You're diversifying your risk by going after those top performers, but within these carefully chosen groups.
Okay, makes sense to me so far. But how did this strategy actually do in the real world? Did it live up to the hype?
Well, that's where it gets even more interesting. The researchers actually tested this whole thing out using, get this, real market data.
Okay, that's good.
And not just some small experiment either. They used a huge global index. This is the big leagues of testing.
Okay, you've got my attention. Give me the good stuff. What happened?
All right, so drum roll. Hierarchical momentum. It consistently outperformed the usual benchmark strategies.
No way, really?
Yeah, and we're not just talking about slightly better either. We're talking significantly better returns. And across almost every way you can measure it.
Okay, hold on. Break it down for me. What does better look like in the real world, in my actual portfolio?
Well, for starters, think higher returns, of course. But, and this is important, we're also talking about potentially smoother sailing. Yeah. Fewer of those terrifying drops that make you want to sell everything and, hide under the table.
Okay, so you're saying this approach, it might actually help me sleep better at night because that's a plus?
Exactly, less stress. Because, you see, it showed lower volatility in their tests, which means fewer dramatic swings.
Right.
And get this, HM even had smaller drawdowns than the other strategies.
Drawdowns, those are those gut-wrenching drops, right? Where it feels like your stomach is in your throat.
Exactly. And remember we talked about those risk-adjusted return ratios, like the Sharpe ratio and the Sortino ratio.
Vaguely. Refresh my memory. What are those again?
Oh, they basically measure how much extra return you're getting for each unit of risk you're taking on.
Oh, okay. Right. Gotcha.
And guess what? HEM, it scored higher on those too. It's like finding a unicorn in the investing world.
Okay. Color me impressed, but there's got to be a catch, right? It all sounds a little too good to be true.
Well, you're right to be, a little cautious. Past performance is never a guarantee and all that. And this is just one study after all.
True.
But still, it's a very compelling one.
It is, I've got to admit. So how does it actually work? What's going on under the hood that makes it tick?
Well, that's where things get, really elegant. You see, it's not just D about momentum, and it's not just D about diversification, right? It's the way those two things work together. That's where the magic happens.
They're like a dynamic duo?
Exactly.
Yeah.
Because, you see, diversification, it helps smooth out some of the volatility that can come with just blindly following momentum.
Right, because even hot stocks, they can cool down eventually, and no one wants to be left holding the bag when that happens.
Exactly. But by diversifying across these carefully chosen groups of similar stocks, you're spreading your risk, right? And so you're potentially capturing more of those upward trends over time.
So it's like you get to aim for those high returns, but you've got a safety net too, just in case. I like it.
That's a great way to put it. And there's another layer to this too that I find really, really fascinating. The researchers, they found that hierarchical momentum's performance, it couldn't be fully explained by those usual market factors.
What do you mean?
It's like it's tapping into something, well, deeper. Some kind of hidden pattern in the market that goes beyond our traditional ways of thinking about risk and return.
Okay, now that is intriguing. So it's like HM, it has like a sixth sense for the market or something?
In a way, yes. And that is what makes this research so groundbreaking, because it suggests there might be more to discover about how markets really work.
Okay, my mind is officially blown. But let's say I wanted to actually try this H&M approach out for myself. How would I go about doing that? What are the practical steps involved?
That's a great question. Well, it all starts with data. You need a way to measure how similar or different stocks are. Based on their price movements. It's like mapping the DNA of the stock market.
Yeah.
You're looking for those hidden family resemblances.
Right. So like building that stock market family tree we were talking about earlier.
Exactly.
Right.
You need a reliable way to figure out who's related to whom, and then you can start grouping those stocks into their respective baskets or clusters.
Got it. Okay, so once we've got our little stock market family reunion all sorted out, what's next?
Then the fun begins. Within each of those clusters, you then look for the stock that has the highest momentum, the one that's had the best recent performance.
So it's like a competition within a competition.
Precisely. Yeah. And the winner from each of those clusters, they earn a spot in your portfolio. So you're creating a team of champions, but from different divisions of the market.
And because those divisions, those clusters, they're based on those real underlying similarities in how the stocks actually behave, you're also building in that layer of diversification and, risk management.
You got it. It's like having an all-star team where each player also has a backup plan.
Right.
Just in case they get injured or something.
I love that analogy. So instead of just betting on these individual superstar stocks, I'm building a whole team.
Right.
With depth and resilience.
Yes, precisely. And here's the best part. This approach, it isn't static. It adjusts as the market changes.
Oh, tell me more about that. How does it adapt?
So as stocks move up and down, their relationships with other stocks, those can shift too.
Okay.
A stock that used to behave a certain way, it might start acting more like a different group of stocks.
So they switch teams mid-season.
In a way, yeah. And so when you recalculate those relationships, your portfolio, it reflects those changes too.
Oh, wow.
So you're not stuck with a static lineup. You're constantly kind of adjusting and adapting your strategy based on how the market is actually behaving.
So it's dynamic, it's adaptable. It's like having a portfolio that can learn and evolve. That's seriously cool.
It is. And there's another risk management feature built into all of this that I think is worth kind of highlighting too.
Okay, what's that?
So remember how we were talking about choosing the stock with the highest momentum within each cluster?
Yeah, the winner from each group.
Right. So if a stock actually has negative momentum, meaning it's actually been on a downswing, you just don't include it, even if it was a top performer before.
So no throwing good money after bad. Got it.
Exactly. You're cutting your losses and focusing on those stocks that are actually showing that positive momentum.
Makes perfect sense. So we've got diversification, we've got momentum, we've got risk management. This hierarchical momentum approach, it really does seem to have it all.
It's a very, very compelling combination. And if the researchers' findings, if they hold up in the real world, this kind of strategy, it could be a game changer.
Wow.
And not just for individual investors, but potentially for the entire financial industry.
So you're saying this could be the future of investing?
It's definitely a glimpse into what's possible. And, one of the most exciting aspects of all this is...
You were saying there's something really exciting about all of this. What is it?
Oh, it's like HM, this whole approach, it's almost like it's tapping into something that traditional finance. It hasn't quite figured out yet. Remember how we were talking about his performance and how it couldn't be totally explained by those, those standard market factors?
Yeah.
It's like it's picking up on these hidden signals or something. It's like almost like a secret language of the market.
It's like we can see around corners. I don't know. That's both incredible and like a little spooky at the same time.
I know, right? It's wild. And for me, that's what makes it so exciting, because it tells us there's so much more to learn. This isn't just about, squeezing out a slightly bigger return. This is about potentially like unlocking a whole new level of understanding about how markets really work.
Yeah, okay. I'm sold. I want to explore this more. Where do I even begin? Like, what are some of the things I should be thinking about? Especially if I wanted to, to dip my toes into this hierarchical momentum thing myself.
I love the enthusiasm. Well, first things first, we got to remember that as promising as all of this research is, it's really just one piece of the puzzle, right? It's like we've stumbled upon this new, potentially much more accurate map.
Okay.
But we still need to kind of test it out, see how it holds up in different terrains,
So what kind of terrain should we be looking at here? Like, what else do I need to keep in mind?
Well, we need to see how HM performs in different market conditions, right? Because the stock market, it's a beast.
Tell me about it.
It can be calm and predictable 1 minute and then bam, total chaos the next.
Yeah.
So how do we know HM can handle the tough times just as well as it seems to handle the good times? That's what we need to figure out.
All right. Right, makes sense.
We need more research. We need to look at how it does over longer time periods across, different economic cycles. And keep in mind, too, this particular paper, it really focused specifically on global stocks.
That's right, it did. But okay, my portfolio, it isn't just stocks, right? So what about other stuff like bonds or real estate?
Exactly. That's a great point. And that's something I would love to see, personally. Could we apply these same HM principles to those other asset classes too? Could we build a truly diversified portfolio where the whole thing is greater than the sum of its parts?
That's the dream, to find that one strategy that rules them all.
Absolutely. And here's something else that I think is really tantalizing to think about. The paper, they used a pretty straightforward way of measuring momentum, right? They were just looking at those past price returns. But what if we got a little more, creative? What if we started incorporating other kinds of signals too? Maybe we look at earnings surprises or, those analyst ratings, and we use that to create a more, shall we say, nuanced momentum measure.
So we could, personalize it a bit more, tailor it to, our own investment style or our goals. I like where this is going.
Exactly. And that's what's so exciting about all this. Is hierarchical momentum. It's not just some, rigid formula. It's a starting point. It's an invitation to explore and to push the boundaries of what we thought was possible in investing.
An invitation I am happy to accept. This has been incredible. Thank you so much for, for walking me through all of this and for being such a fantastic guide on this deep dive into hierarchical momentum. You've given me so much to think about and clearly a lot of rabbit holes to go down.
My pleasure. That's what the deep dive is all about. We're here to spark that curiosity, challenge some assumptions, and hopefully give you the tools to think differently about your investments.
Absolutely. And for everyone listening, if you'd like to take your own deep dive into hierarchical momentum, we'll be sure to include links to the research paper along with some other resources we think you'll find helpful over in the show notes.
Happy investing, everyone.
And until next time, keep exploring those fascinating corners of the market. Who knows what you might discover? Welcome back to the deep dive. Today, we're searching for that holy grail of investing, right? Trying to build a stock portfolio that doesn't just sit there, but actually, grows, but also doesn't give us all heart attacks every time the market takes a dip. And Well, we found some really fascinating research that might just hold the key.
The thrill is in the chase.
Exactly. So buckle up because we're diving headfirst into the world of hierarchical momentum. And to help us navigate these somewhat complex waters, I've got our expert right here with me.
Happy to be here. Always love geeking out about this stuff.
So this paper we're diving into, it starts off by pointing out something I think a lot of us have probably felt. You know, you hear about these fancy Nobel Prize-winning portfolio strategies.
Right.
The Markowitz model. The problem is, well, they don't always work quite as well in the real world, do they?
Yeah, they're great ideas, in theory. But the market, it's evolved. It's like, imagine trying to use a map from the 1800s to navigate a modern city, you know?
I like that analogy.
The amount of data we have about the stock market now is just, it's overwhelming for these older models.
It's like feeding them too much information and they just get indigestion, can't handle it.
Exactly. And then what happens is they might actually end up suggesting portfolios that are way too risky.
Yeah.
You know, concentrated in just a handful of assets.
Yeah, not exactly the recipe for, sound sleep at night.
Exactly, exactly. We need something a bit more robust, something that can handle the data deluge and still give us, good directions.
Precisely. And that is where this idea of hierarchical momentum, or HM, this is where it comes in.
Right.
And it's really fascinating because it's like combining the best of, two different investing worlds' momentum, and then this idea of diversification.
It is. It's a really interesting approach.
So let's break that down a bit. For those of us who maybe skipped finance class, what exactly is momentum investing?
Well, the simplest way to think about it is, it's like that saying, ride the hot hand. It's based on the idea that stocks that have performed well recently, there's a good chance they'll continue to do so for at least a little while longer,
So kind of like sticking with the winner, at least for a bit, hoping the streak continues?
Yeah, basically.
Yeah.
But of course, we don't want to put all our eggs in one basket, right?
Yeah.
We want to diversify, and that's where hierarchical clustering comes into play.
Okay, so now we're adding baskets to the mix. I'm intrigued, but I need a visual. What is hierarchical clustering?
Okay, so imagine you walk into, a giant buffet, right? The stock market buffet, if you will.
I'm with you.
Now, instead of just randomly piling food on your plate, you decide to be strategic about it. So you group similar dishes together, maybe all the seafood in one spot, all the desserts in another, right? You're creating these categories. That's essentially what hierarchical clustering does, but with stocks. You're grouping them together based on how similar their price movements are. So you're creating baskets of stocks based on, their behavior, their personality in the market.
Okay, so finding stocks that, to move together up or down, sort of like dance partners on the market floor?
Exactly, that's a great way to put it.
So with hierarchical momentum, instead of just chasing after the single hottest stock out there, we're trying to pick winners from these different kind of categories. Is that what I'm hearing?
Exactly, you got it. You're diversifying your risk by going after those top performers, but within these carefully chosen groups.
Okay, makes sense to me so far. But how did this strategy actually do in the real world? Did it live up to the hype?
Well, that's where it gets even more interesting. The researchers actually tested this whole thing out using, get this, real market data.
Okay, that's good.
And not just some small experiment either. They used a huge global index. This is the big leagues of testing.
Okay, you've got my attention. Give me the good stuff. What happened?
All right, so drum roll. Hierarchical momentum. It consistently outperformed the usual benchmark strategies.
No way, really?
Yeah, and we're not just talking about slightly better either. We're talking significantly better returns. And across almost every way you can measure it.
Okay, hold on. Break it down for me. What does better look like in the real world, in my actual portfolio?
Well, for starters, think higher returns, of course. But, and this is important, we're also talking about potentially smoother sailing. Yeah. Fewer of those terrifying drops that make you want to sell everything and, hide under the table.
Okay, so you're saying this approach, it might actually help me sleep better at night because that's a plus?
Exactly, less stress. Because, you see, it showed lower volatility in their tests, which means fewer dramatic swings.
Right.
And get this, HM even had smaller drawdowns than the other strategies.
Drawdowns, those are those gut-wrenching drops, right? Where it feels like your stomach is in your throat.
Exactly. And remember we talked about those risk-adjusted return ratios, like the Sharpe ratio and the Sortino ratio.
Vaguely. Refresh my memory. What are those again?
Oh, they basically measure like how much extra return you're getting for each unit of risk you're taking on.
Oh, okay. Right. Gotcha.
And guess what? HEM, it scored higher on those too. It's like finding a unicorn in the investing world.
Okay. Color me impressed, but there's got to be a catch, right? It all sounds a little too good to be true.
Well, you're right to be, a little cautious. Past performance is never a guarantee and all that. And this is just one study after all.
True.
But still, it's a very compelling one.
It is, I've got to admit. So how does it actually work? Like, what's going on under the hood that makes it tick?
Well, that's where things get, like, really elegant. You see, it's not just D about momentum, and it's not just D about diversification, right? It's the way those two things work together. That's where the magic happens.
They're like a dynamic duo?
Exactly.
Yeah.
Because, you see, diversification, it helps smooth out some of the volatility that can come with just blindly following momentum.
Right, because even hot stocks, they can cool down eventually, and no one wants to be left holding the bag when that happens.
Exactly. But by diversifying across these carefully chosen groups of similar stocks, you're spreading your risk, right? And so you're potentially capturing more of those upward trends over time. Welcome to the deep dive. Today we're taking a trip to Wall Street.
Ooh, Wall Street.
Yeah, but instead of, the usual suits and ties,
Right.
we're bringing along something a bit more high-tech, machine learning.
Okay.
Now, before you run for the hills thinking this is all, algorithms and equations and,
It's going to be way over my head.
don't worry, we're going to decode it all.
Okay.
And trust me, it's way more interesting than it sounds.
It is. We're going to break down a research paper
Okay.
titled Interpretable Supervised Portfolios.
H.E.
Yeah. Published back in September 2022 by Guillaume Chevalier, Guillaume Coqueret, and Thomas Raffineau. It tackles a big problem in the world of finance. The problem of black box algorithms.
Okay, so you're saying financial institutions are using machine learning to manage money, but it's all happening in this mysterious black box.
Yeah,
That sounds a little risky, doesn't it?
it can be. Imagine handing over your hard-earned cash to a system,
Yeah.
and nobody can really explain how it works.
Right.
Not even the experts who built it.
Yeah, that's a tough sell.
It is. It all comes down to trust.
I think you're right.
Like, think about it. Would you rather trust a person or a machine you don't understand with your savings?
Definitely a person.
Yeah.
There's got to be a way to have, like, the power of these complex algorithms
Right.
without the mystery, right?
Exactly. That's where interpretable machine learning enters the picture.
Okay.
And that's what this research paper dives into. The authors basically created a way to like crack open that black box and translate the machine's decision-making process into something we humans can understand.
So it's like giving the algorithm a translator. I'm intrigued. Tell me more.
We'll meet the star of our show, RuleFit.
RuleFit?
Yeah, think of it like a detective that sifts through all the data,
Yeah.
finds the key clues, and presents its findings in a way even your grandma could understand.
Okay, I love that.
Right.
No more needing a PhD in computer science to understand my investments.
Exactly.
So how does RuleFit actually work? Let's say we're trying to figure out
Okay.
what makes some houses more expensive than others.
Right, so RuleFit starts with something called decision trees.
Okay.
Picture them as a series of questions
Okay.
with yes or no answers that lead you to a prediction.
Gotcha.
From these trees, RuleFit extracts simple rules.
Okay.
Things like houses near the water are usually pricier, or
Yeah.
bigger houses in safe neighborhoods cost more.
Okay. That makes sense.
Yeah.
So it's like taking the best parts of those decision trees and turning them into like easy to follow guidelines.
Exactly. But it's not just about individual factors.
Okay.
RuleFit also looks for interactions between them. It's like saying, hey, this house is near the water and it has a huge backyard that's a winning combo.
Yeah.
It combines those rules with the original data
Okay.
and uses a method called adaptive lasso to figure out.
Oh, that sounds fancy.
Yeah, well, it's a very cool method for figuring out
Yeah.
which rules and features are most important
Got it.
for making accurate predictions.
So it's like RuleFit is a super smart detective
Right.
who can not only identify the clues, but also understand how they all fit together. Now, the million-dollar question is, can it actually build a portfolio that makes money?
That's what the researchers wanted to find out. They tested RuleFit by building portfolios
Yeah.
using 3 different challenges.
Okay.
10 U.S. industry portfolios like tech or healthcare, 25 portfolios based on company size, and something called the book-to-market ratio.
Hold on. Book-to-market ratio. I'm drawing a blank here.
Yeah.
What exactly is that?
It's essentially a way to compare a company's market value
Okay.
to its book value, which is basically the value of its assets minus its liabilities.
I see.
It's a way to get a sense of whether a company is overvalued or undervalued by the market.
Got it. So it's like figuring out if a house is a steal or a ripoff.
Yeah.
Based on how much it's actually worth
Right.
versus how much people are willing to pay.
Exactly.
Okay, so back to the challenges.
Yeah.
What was the third one?
The final test was using 4 broad asset classes. Global stocks and bonds.
Okay.
It was the ultimate test to see if RuleFit could handle different types of investments.
So they really put it through the ringer.
They did.
And the Struzelets.
Drum roll, please. RuleFit actually performed just as well as those mysterious black box methods when it came to risk-adjusted returns.
Wow.
Yeah. This is big news.
Okay.
It means you don't have to sacrifice performance for transparency.
Now we're talking.
Yeah.
So not only can we understand what RuleFit is doing,
Right.
but it can actually hold its own against the big boys. I'm impressed.
Right. And here's where things get even more exciting. The researchers didn't just stop at building portfolios.
Okay.
They wanted to see if RuleFit could uncover why certain investments do well.
Okay. So it's not just about making money. It's about understanding the secret sauce. This is where it gets really juicy.
You got it. They used a massive data set of U.S. stocks
Okay.
from 1984 to 2020.
Okay.
And get this, they looked at 89 different characteristics for each stock.
89.
89.
Wow. That's like trying to solve a financial puzzle with 89 pieces.
It is. And remember, RuleFit doesn't just look at these characteristics in isolation.
Right.
It also looks at the interactions between them.
Okay.
This means that a particular combination of factors
Yeah.
might be a stronger predictor of performance
Right.
than any single factor on its own.
So it's not just that a company is big,
Right.
but it's big and it's in a growing industry and it has a history of innovation.
Exactly.
It's about seeing the whole picture.
It is. And what's fascinating is that they found some surprising insights.
Like what?
For instance, sin stocks.
Sin stocks.
Yeah. Things like tobacco or gambling companies
Okay.
often performed well.
Hold on, are you saying these are good investments?
Not at all. It's crucial to remember that this is just an observation from the data.
Okay.
RuleFit is simply identifying patterns,
Okay.
not making moral judgments.
Good point.
Yeah.
Okay, so what other aha moments did this research uncover?
Right.
What's the secret to building a winning portfolio?
It turns out it's more complicated than just picking a few magic characteristics.
Okay.
RuleFit found that you need to consider a decent number of characteristics, around 30.
30.
Yeah, to account for 75% of the model's importance.
So much for simplicity.
Right. It challenges the idea that a super simple model will do the trick.
Yeah.
And here's another key finding.
Okay.
The importance of different characteristics actually changes over time.
So what worked in the 80s might not work so well today. Makes sense, the markets are constantly evolving.
Exactly. What was once a hot investment
Right.
can quickly become outdated.
Yeah.
Just like fashion trends.
Oh yeah, for sure.
You know?
Okay, this is all super interesting, but can you give me like a concrete example of how these characteristics and rules
Yeah.
might play out in the real world?
Absolutely. Let's take a look at Table 6 from the paper. One of the key characteristics highlighted is something called DEVO.
DEVO,
Yeah, short for dividend omission.
dividend omission.
Yeah, RuleFit found that this played a significant role
Okay.
in recommending portfolio weights.
Meaning that whether a company pays dividends or not
Uh-huh.
is a major factor in deciding how much to invest.
Exactly. And think about it, companies that consistently pay dividends
Yeah,
are often seen as more financially stable,
right.
which can make them attractive to investors.
So it's like RuleFit is giving us a peek behind the curtain
Yeah.
of what drives investment decisions. Pretty cool stuff.
It is. It's really fascinating stuff. This interpretability is really powerful.
Yeah, I'm really glad we're diving into this. Because I think it's, a really important topic.
Yeah, and one that has a lot of potential to really change.
Yeah.
The way we think about investing. Yeah, it really does highlight how those seemingly small details, like whether a company pays dividends, can actually have a big impact. And RuleFit helps us connect those dots.
This is blowing my mind. Before diving into all of this, I kind of had this naive idea that these fancy algorithms could just, spit out a magic formula for picking stocks, some secret code to unlock riches beyond my wildest dreams.
It's a tempting thought, isn't it? But as this research shows, the markets are way more complex than that. It's not about finding a single magic bullet, but rather understanding a whole range of factors and how they interact with each other and how those relationships can shift over time.
Right, because like you said, what worked in the 80s might not work today. It's like fashion trends, shoulder pads were all the rage back then. But try wearing those on Wall Street today and you'd probably get some strange looks.
Exactly, and we can actually see this in Figure 3 from the paper. It shows how the importance of even those top-performing characteristics fluctuates across different time periods. For example, DEVO, that dividend emission characteristic we were talking about, was a big deal in certain years, but less so in others.
So even with this sophisticated model, it's not like you can just set it and forget it. You need to constantly adapt and reassess, just like a savvy investor would.
Absolutely. Markets are dynamic, and any successful strategy needs to be able to keep up with those changes.
Okay, I'm starting to see what makes this research so groundbreaking. It's not just about building a better investment model. It's about building a model that we can actually understand and learn from. It's like having a financial mentor that shows you their thought process, not just their final decision.
I couldn't agree more. That interpretability is key. By shining a light on the decision-making process, we can gain a deeper understanding in how markets work, what factors really drive performance, and ultimately make more informed choices. It's about empowering investors, not replacing them.
So let's talk about the practical side of things. How could this technology actually be used in the real world? What kind of impact could this have on, say, financial advisors and your clients?
The possibilities are pretty exciting. Imagine a financial advisor sitting down with a client and being able to clearly explain why they're recommending certain investments. Using those simple rules that RuleFit uncovers, it could build a whole new level of trust and transparency in a field that can sometimes feel like a black box itself.
Right. No more vague explanations or just relying on blind faith. Instead, you've got concrete evidence and a clear understanding of the why behind the recommendations.
Exactly. And this technology could be a game changer for individual investors as well. It could give them the tools to make more informed decisions about their own portfolios, rather than relying solely on the advice of others.
It's like giving everyone access to a financial GPS that not only tells you where to go, but also explains the route and why it's the best path for you.
That's a great analogy. And remember, this research specifically focused on building portfolios. But think about all the other areas of finance where interpretable machine learning could be applied. From risk management to fraud detection, loan approvals, and even things like insurance pricing, the potential is enormous.
Wow. It really feels like we're on the verge of a revolution in how we interact with the financial world.
We are, and as with any revolution, there will be challenges and questions to address. But this research is a powerful reminder that we don't have to sacrifice understanding for innovation. We can have both.
And that's an incredibly exciting prospect. This deep dive has been absolutely fascinating. It feels like I've learned so much about how machine learning is reshaping the financial landscape.
I'm glad to hear that. It's definitely a complex topic, but hopefully we've managed to shed some light on it and spark some curiosity in our listeners.
You definitely have. So to all our listeners out there, if you're eager to learn more about this research, we'll be sure to include a link to the original paper in the show notes. And we'd love to hear your thoughts on this episode. Join the conversation on our social media channels. We're always eager to hear your perspectives.
It's been a pleasure exploring this with you. Until next time, keep those minds curious and stay tuned for more deep dives into the fascinating world of knowledge.
And remember, even in the world of high finance, it's not magic, it's understanding. Thanks for listening.
Yeah, it's incredible to think that we're moving from a world of financial secrets and intuition to one where we can actually see the logic,
Yeah.
behind the decisions, even when those decisions are made by machines.
It's like we've been handed a powerful new lens to examine the financial world. And the more we understand how things work, the better equipped we are to navigate it, whether we're seasoned investors or just starting out. Right. It's not about replacing human expertise, but rather augmenting it. Like you said, there will always be challenges and questions to grapple with. But this research feels like a huge step in the right direction.
I agree. And it's important to remember that this is just the beginning. The field of interpretable machine learning is constantly evolving, and we're only just scratching the surface of what's possible.
So what's next? Where do you see this technology heading in the future? What are you most excited about?
One area I'm particularly excited about is using this technology not just to understand past data, but to make predictions about the future. Imagine if we could use RuleFit to not only identify which stocks have performed well historically, but also to anticipate which ones are likely to outperform in the years to come.
That's mind-blowing. It would be like having a crystal ball for the stock market.
Right.
But with that kind of power comes a lot of responsibility, right? We need to be careful about how we use these tools.
Absolutely. As these technologies become more sophisticated, it's crucial to ensure they're used ethically and responsibly. We need to be mindful of potential biases in the data to safeguard against unintended consequences, and to make sure that these tools are accessible to everyone, not just a select few.
It's like we're entering a new era of financial exploration, and we need to chart this course carefully, making sure we're using this incredible power for good.
Well said. And it's a journey that requires all of us to participate: researchers, policymakers, investors, and the public alike. The more we understand these technologies, the better equipped we'll be to shape their development and ensure they serve us all.
This has been an incredible deep dive. Thank you so much for sharing your expertise and insights with us today. I feel like I've gained a whole new understanding of how machine learning is shaping the future of finance.
It's been a pleasure. It's exciting to see how this research is sparking curiosity and opening up new possibilities. And I'm confident that together we can harness these powerful tools to create a more transparent, equitable, and prosperous financial future.
To all our listeners, we hope this deep dive has inspired you to explore the world of interpretable machine learning and its impact on finance. Be sure to check out the show notes for links to the research paper and other resources. And as always, we'd love to hear your thoughts. Join the conversation on our social media channels. Until next time, keep those minds curious and never stop exploring.